There is a pattern that every experienced investor eventually learns. Not from a textbook. Not from a YouTube channel. Not from a Bloomberg terminal. Bitcoin is winter. Ethereum is spring. Solana is summer. XRP is fall. And BNB is something that does not fit cleanly into any of the four seasons. And the reason it does not fit is the most interesting thing about BNB that almost nobody is discussing in 2026. But before this video goes any further, nothing here is financial advice. Not a single sentence. Every asset discussed is volatile, high risk, and capable of moving in any direction without warning. This is pattern recognition. Historical analysis. A framework for thinking about market cycles more clearly. What you do with it is entirely your own decision, and you should always consult a qualified financial professional before making any financial decisions with your capital. Let us talk about winter. Picture a city in deep winter. January, 2 in the morning. The streets are empty. The noise is gone. The chaos of the summer crowds and the autumn harvests and the spring blooms, all of it has been replaced by something quieter, colder, and in its own way, more honest. Winter does not pretend. It does not perform. It simply is what it is, stripped of everything temporary, revealing only what is permanent, only what is built to last through the cold. Bitcoin is winter. Not because Bitcoin is cold or unfriendly or hostile to growth. Winter is the season of endurance. The season where only the things with deep enough roots survive. The season where the surface looks dead but the structure underneath is the most durable it will ever be. And in the winter of 2026, with Bitcoin sitting at approximately $80,000 after falling from its October 2025 peak of $126,000, down 37% from its all-time high, this is exactly where Bitcoin stands. Stripped, cold, quiet, and underneath the quiet, more structurally solid than it has been at any prior point in its history. The data confirms the season with uncomfortable precision. Bitcoin's exchange balances are at multi-year lows. Long-term holder supply, the coins that have not moved in over a year, sits near all-time highs. The RHODL ratio, Glassnode's measure of long-term holder conviction relative to short-term speculation, reached 4.5 in early 2026, the third highest reading in Bitcoin's history. The only comparable readings occurred at the 2015 cycle bottom and the 2022 cycle bottom. Both were followed by the two most significant bull markets Bitcoin has ever produced. The long-term holders are not selling. They are accumulating. In winter, the smart money does not flee the cold. It digs in. And Wall Street, the institutional layer that was not present in any prior Bitcoin cycle, is doing something in winter 2026 that is deeply consistent with the seasonal logic. They are building. BlackRock's ETH holds more Bitcoin than all but a handful of entities on Earth. Strategy, Michael Saylor's firm, executed a $2.54 billion Bitcoin purchase in April 2026, 34,164 BTC in a single move. Cumulative spot Bitcoin ETF net inflows have crossed $57 billion since January 2024. These are not the actions of institutions that believe winter is permanent. These are the actions of institutions that understand exactly what winter is, a window. The coldest, quietest, most uncomfortable window. And the only window in which the next cycle's foundation gets laid. Winter has another quality that most people forget until they are living through it. It is the season where the weak hands leave. Not because they want to. Because they cannot stand the cold. In the summer of 2025, when Bitcoin was at $126,000 and Ethereum was near $5,000 and Solana was above $200 and the entire market smelled like euphoria, the leverage in the system was extraordinary. Billions in open interest. Funding rates screaming positive. Retail sentiment at maximum greed. Every asset moving in the same direction at the same time for reasons that felt, in the moment, completely rational and permanent. Then winter came. The derivatives-driven unwind began in late 2025. The macro fear and liquidity contraction followed in early 2026. The U.S.-Iran conflict drove oil above $100 a barrel. Inflation returned. The Federal Reserve, frozen at 3.50% to 3.75%, had no room to cut. Risk assets fell. Bitcoin fell hardest in absolute dollar terms, from $126,000 to $60,000 at its trough, a 52.5% decline. But relative to every other major asset in the crypto ecosystem, Bitcoin fell the least. XWIN Japan's comparative analysis, published May 11, 2026, documented what it called internal selection, the process by which investors systematically separated Bitcoin from the broader altcoin market during the stress period. Even during market stress, capital consistently returned to Bitcoin. The report described it as having become a global macro asset rather than just a crypto token. This is what winter produces. Not destruction. Selection. The cold does not kill everything. It reveals what was built to last. Bitcoin was built to last. The 21 million hard cap, the halving cycle that reduces new supply every 4 years, the proof-of-work security model that has operated for over 15 years without a single successful attack, these are not features of an asset in decline. These are the roots of a tree in winter. Invisible from the surface. More important than anything above ground. But even in winter, something is already changing. The first buds of spring are already forming underground, invisible to anyone not looking closely enough. And to see them, you have to turn your attention from Bitcoin to the asset that represents the next season in the cycle's progression. Ethereum is spring. Spring is the most complex season. Not the most dramatic, that is summer. Not the most stable, that is winter. Not the most abundant, that is fall. Spring is the season of transformation. The season where the infrastructure that survived the winter begins, slowly, tentatively, to come back to life. The season where the things that were planted before the freeze start to break through the surface. Where the old and the new exist simultaneously, sometimes uncomfortably. Where the promise of what comes next is real, but not yet fully visible. Ethereum is spring because Ethereum in 2026 is caught between two states. Between what it was, the dominant smart contract platform, the foundation of DeFi, the infrastructure that every financial institution on Earth is currently studying, and what it is becoming. The transformation is underway. But transformations, in their intermediate stages, are not clean. They are not bullish. They are not bearish. They are complicated. And complicated assets, in a market that rewards simplicity, get left behind while the transformation completes. Picture a city in early spring. The snow is melting. The streets are wet and gray. The trees are not yet green, just the faintest blush of something trying to emerge. The air smells like possibility and mud at the same time. This is Ethereum's price chart in 2026. $2,300. Range-bound between $2,100 and $2,400. Holding the psychological floor. Not collapsing. Not surging. Existing in that uncomfortable intermediate state that spring always produces before it becomes what it was always going to be. The structural spring beneath Ethereum's surface is more visible than the price suggests. Spot Ethereum ETFs recorded their best inflow streak since July 2024, 10 consecutive weeks of positive flows through late April 2026. BlackRock's ETHB, the staking-enabled spot ETF, represents the first institutional product that allows regulated capital to earn yield on Ethereum holdings, a structural development that did not exist a year ago. Bitmine has accumulated over 4.17 million ETH, representing approximately 3.45% of circulating supply. That is an institutional vote of confidence measured not in words but in capital deployed at current prices during maximum skepticism. And speaking of summer, turn your attention now to the asset that is living in full, blazing, reckless, extraordinary summer right now, even after everything the 2026 bear market tried to do to it. Solana is summer. Summer is the most intense season, the most alive, the most extreme, the season of maximum heat, maximum energy, maximum activity, and maximum exposure. Summer does not hedge. It does not qualify. It goes to the absolute limit of what the environment can support, and then it asks for more. And Solana, in every metric that actually measures network vitality rather than speculative price, is operating in full summer. Feel this for a moment. On-chain transaction volumes on Solana hit a record $1 trillion in Q1 2026. $1 trillion of value settled on a network that is currently trading 50% below its 2025 all-time high. 27 million active addresses in mid-January 2026, a 56% week-over-week increase. 1,100 transactions per second averaged across 2025, a 34% year-over-year improvement. 121 billion total transactions for the year. The Firedancer validator client, developed by Jump Crypto, is rolling out its infrastructure improvements steadily, strengthening the network security and decentralization even as the price sits suppressed. Goldman Sachs disclosed a nearly $108 million position in spot SOL ETFs. Total AUM across Bitwise, Fidelity, and Morgan Stanley SOL products crossed $1 billion. Solana has been called, by analysts at Crypto.com, the institutional proxy for blockchain scalability, the asset that Wall Street is using to express a specific bet on network performance as the dominant value driver in the next cycle. This is what summer looks like from the inside. Explosive, productive, alive in every direction simultaneously. And, like all summers, dangerous. Because summer is also the season of maximum vulnerability to weather. And the weather in 2026 has been brutal for Solana specifically. The $285 million exploit on the Drift protocol in early April 2026, one of the largest DeFi exploits in Solana's history, arrived at exactly the wrong moment, when the market was already stressed and institutional confidence was fragile. XWN Japan's data shows Solana as the worst-performing asset in the 6-month stress period from October 2025 to April 2026, down 71.6% from $238 to $67. The most intense summer is also the one with the most violent storms. But here is what summer teaches about markets that winter never can. Summer assets are not assets to abandon when the storm arrives. They are assets to understand in the storm. The $285 million exploit did not break Solana's infrastructure. The ecosystem responded, patched, and continued. On-chain volumes kept climbing. Active addresses kept expanding. The network's fundamental vitality, its actual real-world usage, did not correlate with its price in the way that winter assets do. Bitcoin's price tracks its store of value narrative. Solana's price tracks something messier, the gap between its current network utility and the market's current willingness to price that utility. In a macro-stressed environment, that gap can be enormous. And enormous gaps, in the direction of underpricing, have historically been the setups that summer assets produce right before the next bull cycle begins. Solana's Alpenglow upgrade, replacing proof of history and Tower BFT with voter and rotor components capable of finalizing blocks in 100 to 150 milliseconds, is not a marginal improvement. It is a consensus mechanism redesign that places Solana in a different performance category from every other Layer 1 blockchain currently operating. No other major network has matched this throughput at this security level. Goldman Sachs is not allocating $108 million to Solana because of the price chart. They are allocating because of what that throughput means for the next generation of financial applications, high-frequency settlement, on-chain derivatives, real-world asset tokenization at institutional scale that require a network with exactly Solana's performance profile. Summer is not safe. Summer assets are not for the risk-averse. But summer is where the most consequential wealth in every crypto cycle has been built. Not by the people who bought at the top of summer's heat, but by the people who bought during the winter storm when the summer asset looked most broken and most irrelevant and most impossible to defend to a skeptical audience. Solana at $95 in May 2026, with $1 trillion in quarterly on-chain volume, is that specific combination. But even summer ends. And when summer ends, the most abundant season begins. The season of harvest. The season of collection. The season where everything that was planted in spring and cultivated through summer becomes, finally, available to be gathered. This is fall. And fall, in 2026, belongs to XRP. XRP is fall. Fall is the season that gets the least attention. It is not dramatic like summer. It is not primordially patient like winter. It is not full of transformation's promise like spring. Fall is the season of practical abundance, of assets that are finally delivering what was always built into them, years and decades in the making. The season where the long-term preparation meets the moment. And XRP in 2026 is the most perfect expression of that seasonal logic in the entire crypto market. The 5-year SEC lawsuit that hung over XRP like a permanent cloud, the legal uncertainty that prevented every major institution from touching the asset, that suppressed its price for half a decade, that made it the most controversial asset in regulated finance, ended in August 2025. Ripple paid $50 million, far below the $125 million the SEC originally demanded. The case closed. And in March 2026, both the SEC and the CFTC formally recognized XRP as a digital commodity. The harvest that XRP holders had been waiting for since December 2020, when the SEC first filed its lawsuit, had arrived. Smell this season. Picture a farm in October. The air is cool but not cold. The light is golden and low. The fields that were green and uncertain all summer are now heavy with the actual fruit of everything that was planted. This is XRP in 2026. The legal uncertainty is gone. The regulatory framework is clear. The Clarity Act, which would permanently codify XRP's commodity classification into federal law, is in Senate markup with a May 21, 2026 deadline. Singapore's central bank tested financial settlements on the XRP ledger. The Rust stablecoin crossed $1.56 billion in market cap. Every experienced investor eventually learns that markets move in seasons, not random chaos, but sequential, cyclical, structurally predictable phases that repeat across every major asset class in history. In 2026, 5 of the most consequential crypto assets ever created are each living inside a completely different season simultaneously. And understanding which season each asset is in changes everything about how you read the current price action. Bitcoin is winter. Stripped of speculation, revealing only what is built to last. RHODL ratio at 4.5, third highest in Bitcoin's history. Long-term holder supply near all-time highs. $57 billion in cumulative ETF inflows. Strategy's $2.54 billion April purchase. The coldest, quietest, most structurally solid moment Bitcoin has ever produced. Ethereum is spring. Caught between what it was and what it is becoming. 10 consecutive weeks of ETF inflows. BlackRock staking-enabled ETHB. Glamsterdam upgrade targeting MEV fairness and Layer 2 fee rebalancing. Transformation underway, uncomfortable, slow, and historically the highest optionality moment in any cycle. Solana is summer. $1 trillion in Q1 2026 on-chain volume. 27.1 million active addresses. Goldman Sachs $108 million SOL ETF position. Alpenglow targeting 150 milliseconds block finality. Maximum energy, maximum vitality, maximum exposure. The season where the most consequential wealth in every crypto cycle gets built. XRP is fall. 5 years of SEC litigation ended. Digital commodity status confirmed by SEC and CFTC in March 2026. Clarity Act in Senate markup. $1.44 billion in cumulative ETF inflows. 570 million tokens moved to long-term wallets. The harvest of everything planted through a half-decade of legal winter, finally arriving. And BNB. BNB is the asset that does not fit any of the 4 seasons. And the reason it does not fit is the most important thing about BNB that almost nobody is talking about in 2026. Warning: this is not financial advice. All content is strictly for educational and informational purposes only. Cryptocurrency is an extremely high-risk asset class. Always conduct your own independent research and consult a qualified financial professional before making any financial decisions.